Oil is not just fuel. It is the hidden backbone of modern civilization. It moves planes, ships, trucks, factories, farms, plastics, chemicals, and even parts of the global food system. So if 20% of the world's oil suddenly disappeared overnight, the impact wouldn't be a normal economic shock. It would feel more like someone quietly removed one of the main support beams holding up the global economy, and everything would start adjusting instantly, painfully, and unpredictably. Let's walk through what would realistically happen. The first 24 to 72 hours, panic in the system. If 20% of global oil supply vanished without warning, markets would react faster than governments. The first response wouldn't be policy, it would be panic pricing. Crude oil benchmarks like Brent and WTI would likely spike sharply because traders would immediately price in scarcity. Even before ships, factories, or airlines feel the shortage physically, the financial system would react to expectations. Countries and major producers, such as Saudi Aramco, would face intense pressure to increase output. But in the real world, production can't scale instantly. Oil wells are not taps you can just open wider overnight. Meanwhile, organizations like OPEC would likely call emergency coordination meetings, trying to stabilize output among member states. But in the first few days, coordination always lags behind markets. So what you get is sudden price spikes, panic buying of fuel governments, assessing reserves, airlines and logistics companies, hedging costs immediately. Even if nothing has physically stopped moving yet, the fear of disruption starts changing behavior instantly. Fuel prices surge, and everything else follows. Oil prices don't stay isolated. They spread through the entire economy like ink in water. If global supply drops by 20%, prices could rise far more than 20% because demand doesn't adjust instantly. That means gasoline becomes significantly more expensive. Diesel, which powers freight transport, spikes even more. Jet fuel costs rise sharply. This triggers what economists call a cost-push inflation cycle. Because almost everything moves on trucks or ships, higher fuel costs flow into food prices, manufactured goods, fertilizers, packaging, construction materials. Even products that don't use oil directly still depend on oil somewhere in their supply chain. So the real effect is not just expensive fuel, it's expensive everything. Transportation chaos, the first visible shock. Transportation is where ordinary people feel the crisis first. Airlines would likely reduce flight routes, increase ticket prices, ground less profitable flights. Shipping companies would slow routes or consolidate cargo, increasing delivery times worldwide. Road transport would become the biggest pressure point. Trucking companies would pass fuel costs to customers almost immediately. This leads to delayed goods, empty shelves in some regions, higher logistics costs baked into retail prices. In countries heavily dependent on imports, especially energy-importing economies like the United States, India, and parts of Europe, the shock would be visible in supermarkets within weeks. Strategic oil reserves get released. Most major economies maintain emergency oil stockpiles for exactly this kind of scenario. For example, the U.S. Strategic Petroleum Reserve emergency reserves in Europe and Asia governments would release these reserves to temporarily stabilize supply. But here's the problem. Strategic reserves are designed for short disruptions, not a permanent 20% global loss. So they would soften the initial shock, slow down price escalation, buy time for policy response. But they cannot fully replace lost global production. It's like using an emergency generator during a citywide power failure. It helps, but it doesn't restore full capacity. The economic ripple effect, inflation and slowdown. Once energy becomes expensive, inflation spreads quickly. Central banks would face a dilemma. Raise interest rates to control inflation leads to risk recession. Keep rates low to support growth. leads to risk runaway inflation. Either option creates economic stress. Industries that rely heavily on energy, like manufacturing, aviation, agriculture, and chemicals, would be hit hardest. Even GDP growth in major economies would likely slow significantly. In severe cases, the world could enter a stagflation-like environment, high inflation plus slow economic growth. Food prices rise. Yes, even food. One of the least obvious but most important impacts would be on food. Oil is used in farm machinery, fuel fertilizer production, natural gas link, transportation of food processing and packaging. So when oil prices rise, food prices follow. This would hit developing countries hardest, where a larger portion of income is spent on food. Even small price increases in staples like wheat, rice, and cooking oil could create social pressure in vulnerable regions. Geopolitical tension increases. A sudden 20% reduction in global oil supply would not be evenly distributed. Some countries would be affected more than others, depending on imports, reserves, and domestic production. This creates geopolitical tension. Countries with strong production capacity or reserves would gain leverage. Countries heavily dependent on imports would face urgency and vulnerability. Major producers like Saudi Arabia, via Saudi Arabia, and the United States would become even more strategically important. Energy security would become a top national priority again, potentially reshaping alliances and trade agreements. In extreme cases, competition for supply contracts could intensify diplomatic friction. Accelerated shift to alternatives. One of the long-term effects would actually be the acceleration of the energy transition. When oil becomes expensive and unreliable, alternatives become more attractive. Electric vehicles, renewable energy, solar, wind, biofuels, hydrogen technologies. Companies and governments would increase investment in energy diversification simply to reduce dependence on volatile oil markets. This doesn't happen instantly, but historically, energy crises often trigger long-term structural shifts. The 1970s oil shocks, for example, significantly changed global energy policy for decades. A modern 20% supply shock would likely do something similar, but faster due to technological readiness. Winners and losers in the crisis. Not everyone loses in such a scenario. Likely winners: renewable energy companies, electric vehicle manufacturers, energy-efficient logistics firms, domestic oil producers in stable regions. Likely losers: airlines, shipping companies, heavy manufacturing, oil import-dependent countries, low-income households. Due to inflation sensitivity, the imbalance of impact would widen inequality between energy-rich and energy-poor economies. The psychological impact: fear becomes a market force. Beyond economics, there is psychology. Energy shocks don't just change prices, they change expectations. Consumers may reduce spending, delay purchases, stockpile fuel or essentials. Businesses may delay investment, reduce hiring, increase prices preemptively. This creates a feedback loop where fear itself deepens the slowdown. Could the world fully collapse from this? No, but it wouldn't stay calm for long either. A sudden 20% disappearance of global oil supply wouldn't end modern civilization, but it would push it into one of the most intense stress tests imaginable. The key idea is this: modern economies don't collapse instantly from shocks like this. They strain, reprice, and reorganize. But that process is messy, uneven, and often painful. What would actually happen? Instead of a clean collapse, you'd see a chain reaction across systems that depend on energy stability. 1. Short-term global recession. Economic activity would slow almost immediately. Higher fuel prices ripple into transport, manufacturing, agriculture, and trade. Businesses cut costs, delay investments, and reduce hiring. Consumer spending weakens because everything, from groceries to travel, becomes more expensive. This isn't just a downturn, it's a coordinated slowdown across nearly every sector at once. 2. Sustained inflation pressure. Energy shocks don't just raise fuel prices, they spread through the entire price system. Transport costs rise, leads to goods become more expensive. Fertilizer and farming costs increase, leads to food prices climb. Manufacturing input costs increase, leads to retail prices adjust upward. The result is persistent inflation, not just a temporary spike. Central banks would struggle because tightening policy slows growth further, while easing policy risks overheating prices. 3. Supply chain restructuring. Global supply chains are built on one assumption: cheap, predictable oil. When that assumption breaks, companies don't just absorb losses, they redesign systems. You would likely see shorter supply chains, regionalization instead of globalization, increased inventory buffering, just in case instead of just in time, higher logistics redundancy, slower but more resilient trade networks. Efficiency gets sacrificed in favor of stability. 4. Long-term acceleration of the energy transition. High oil prices don't just create problems, they also shift incentives. Suddenly, alternatives that were too expensive before become competitive. Electric vehicles become more attractive, renewable energy investment surges, industrial efficiency, upgrades accelerate, governments subsidize diversification aggressively. In other words, the crisis would act like a forced upgrade cycle for global energy systems. 5. Geopolitical realignment in energy markets. Energy is power, literally and strategically. A 20% supply loss would reshape global influence. Oil-producing states gain leverage, import-dependent nations become more vulnerable, long-term contracts and alliances shift, strategic reserves become political tools. Countries like Saudi Arabia and institutions like OPEC would become even more central to global negotiations, while import-heavy economies scramble to secure long-term supply stability. Final thought: oil is more than fuel. It's a system. The biggest misconception about oil is thinking of it as just energy. In reality, oil is transportation infrastructure, industrial input, agricultural support system, global trade enabler. So when 20% disappears, it's not just less fuel in tanks, it's friction added to almost every system that modern life depends on. And systems with friction don't stop immediately. They slow down, strain, and reorganize. That is what makes the impact so powerful. If this scenario made you rethink how dependent the world is on energy, take one step further. Pick one everyday product you use, food, clothing, or electronics, and trace how oil likely played a role in it: transport, manufacturing, packaging, or logistics. You'll quickly realize something important. We don't just use oil. We live inside systems built around it. And understanding those systems is the first step to understanding where the world is heading next. And if you found this breakdown useful, like, subscribe, and comment your thoughts.